Revenue up 16%, gross margin at its highest point in over a year, non-GAAP profit up 56%. On paper, a strong quarter. But here's the question nobody is asking out loud. If Tesla delivered fewer cars than any quarter in the past year, how did gross margin just hit 21%? That gap between volume and profitability is the entire story of this quarter, and it doesn't explain itself. When you look at this revenue number, $22.4 billion, the instinct is to read it as one thing. It isn't. Three completely different businesses are inside it, and they moved in three completely different directions this quarter. Automotive grew 16% year over year, but it came with fewer deliveries, 358,000 units. So the revenue per car went up. That matters, and we'll get there. Energy, the segment that was supposed to be Tesla's second engine, dropped 12%, from $3.8 billion last quarter down to $2.4 billion. Weakest energy quarter in over a year. And then services and other, the quiet one, grew 42% year over year, $3.75 billion. It is now larger than the entire energy segment. 3 lines, 3 completely different trajectories. So when someone says Tesla had a 16% revenue quarter, which Tesla are they actually talking about? Tesla delivered the fewest cars of any quarter in this entire sequence and posted its highest automotive gross margin, 21.1%. Strip out regulatory credits, the payments other automakers send Tesla for not meeting emission standards, and the underlying margin is 19.2%, also the highest in this series. So the improvement looks real. And structurally, a lot of it is. Lower material costs, better product mix, higher average selling price. But here's what Tesla itself disclosed in its own commentary. And this is the line that deserves full attention. Part of this margin expansion came from one-time benefits, warranty adjustments, tariff-related gains in both automotive and energy. These are not recurring by nature. Tesla didn't hide this. It's in the release. But it's easy to miss when the headline number says 21%. Now look at the 2 lines moving in opposite directions on this chart. Deliveries going down, margin going up. That divergence can mean the business is genuinely getting more efficient per unit, or it can mean volume is soft and one-time items are filling the gap. The honest question is, when the one-time benefits are gone and volume comes back at scale, where does this margin actually land? Profit lines can be shaped. Cash flow is harder to fake. Operating cash flow, $3.9 billion. The strongest Q1 in this entire data series. After spending $2.5 billion on capital expenditures, factories, AI infrastructure, battery lines, superchargers, the business generated $1.44 billion in free cash. FCF margin of 6.4%. The cash position sits at $44.7 billion. Now, this quarter, Tesla also deployed $2 billion to acquire a stake in SpaceX. That came through investing activities, not operations. The business generated enough cash to absorb it without touching the operating story. But look at CapEx. It's not shrinking. $2.5 billion out the door this quarter alone. Cybercab lines, Tesla Semi, Megafactory Houston, Cortex-2 AI compute, lithium refining, LFP cells. $44.7 billion in cash. $2.5 billion per quarter being deployed into infrastructure that doesn't generate revenue yet. That's either a company with an extraordinary runway or a company that needs every dollar of that cushion to fund what's coming next. Which one it is depends entirely on whether those investments deliver on schedule. R&D spending crossed $1.95 billion this quarter, nearly $2 billion in 90 days on research and development alone. A year ago, that number was $1.4 billion. It's grown 38% year over year. Now, here's where the efficiency lens matters, because spending more isn't inherently bad. The question is whether the spending is generating leverage. Look at the two rows at the bottom of this chart. Revenue per dollar of OPEX, $7.03 a year ago, $5.92 today, falling. Gross profit per dollar of R&D, $2.23 a year ago, $2.42 last quarter. It actually improved. Now back to $2.42, holding, not expanding. What this tells you is that the spending is growing faster than the output it's currently generating. That's not unusual for a company mid-transition. You spend before you earn. But it does mean the margin pressure from OPEX is real and it's getting heavier, not lighter. Operating margin came in at 4.2%, up significantly from the 2.1% disaster of Q1 last year, but down from the 5.7% of last quarter. Tesla is spending at the pace of a company building something entirely new. The efficiency ratios will only improve when that something starts generating revenue at scale. The spending is visible. The return on it, still ahead. For 2 years, Tesla's energy business has been the growth story investors were told to watch. Record deployments, record margins, 5 consecutive record quarters through Q4. Then, Q1 2026 arrives. Energy drops 12%. Storage deployed hits its lowest point in 5 quarters, 8.8 gigawatt hours. Tesla's explanation? Production timing. Megapack ramp cycles. Large utility contracts don't ship on a perfectly even schedule. That's true, and it's worth taking at face value, for now. But here's what the chart shows that the headline doesn't say clearly enough. Energy revenue moves like a project business. It spikes when large deployments close and drops when the pipeline clears. It is fundamentally cyclical. Services moves like a subscription business. Look at the trajectory. $2.64 billion, $3.05 billion, $3.48 billion, $3.37 billion, $3.75 billion. It barely paused. It compounds quarter after quarter. In the engine underneath it, FSD subscriptions just crossed 1.28 million users, up 51% year over year. These two revenue streams are not the same thing. $1 of energy revenue and $1 of services revenue have fundamentally different quality. One requires a new project to replace it, the other renews itself. So here's the refined question. If services is now larger than energy and growing at more than twice the rate, why is the market conversation still centered on megapack deployments? Here's where the story becomes the most interesting and the most uncertain at the same time. FSD subscriptions, 1.28 million paying users, up 51% year over year. That revenue is real, and it's flowing through the services line we just looked at. Robotaxi paid miles nearly tripled sequentially. Austin expanded its unsupervised zone. Dallas and Houston launched, both after this quarter closed, so those aren't even in these numbers yet. Netherlands approved FSD in April, which opens a regulatory path into the broader EU. The Cybercab entered pilot production at Gigafactory Texas this quarter. There's a team photo. The line exists. The vehicle exists. And Tesla completed the final chip design for AI5, its next-generation inference processor, in April. Now hold all of that together and notice what's missing. There is still no dedicated revenue line for Robotaxi, no disclosed FSD revenue breakdown, no per-mile economics disclosed. The entire autonomous business, which is arguably the single largest variable in Tesla's long-term valuation, is still embedded inside a single aggregated services number. Investors are being asked to price a business they can't yet measure. The miles are growing, the cities are expanding, the technology is advancing. But at what point does a business that can't be measured separately start needing to be disclosed separately so the people funding it can actually evaluate what they own? The balance sheet expanded nearly $6 billion in a single quarter. Most of that story is straightforward. PP&E up $2.6 billion reflects factories being built, AI clusters going online, battery lines ramping, capital being deployed. But two numbers deserve a closer look. Inventory jumped $2 billion. Days of supply went from 15 to 27. Tesla is sitting on almost twice as many days of unsold vehicles as it was 90 days ago. That could be intentional, building stock ahead of new model launches, Cybercab ramp transitions, or new market entries. Tesla did begin Cybertruck deliveries in the UAE this quarter. Or it could be early softness in demand in certain markets. The number alone doesn't tell you which. Debt moved up $870 million, still entirely manageable against $44.7 billion in cash. That's not the concern. The direction is worth noting. And then look at the cash line. It only grew $600 million despite $3.9 billion in operating cash flow. The difference went to CapEx, the SpaceX investment, and debt management. This is a balance sheet in active, deliberate expansion. The question isn't whether Tesla can sustain it. The cash position answers that clearly. The question is simpler. Inventory at 27 days of supply, in a quarter where deliveries were already at a 5-quarter low. Is that a setup for a strong Q2 or a signal that demand needs attention? Put the two columns side by side and sit with what you're actually looking at. The same quarter, the same 90 days, the same company, gross margin at its highest point in over a year. And part of it came from items Tesla itself flagged as non-recurring. Services growing 42%, while energy, the segment built for exactly this diversification story, dropped 12% in the same quarter. Free cash flow expanding, while CapEx keeps growing and inventory just doubled in days of supply. FSD subscribers up 51%, with no dedicated revenue line to measure what that business actually generates. This is not a clean quarter. It's not a disaster either. It's something more specific than both of those reads. It's a company in genuine transition, where the signals of what's working and what isn't are pulling in opposite directions simultaneously. Two scenarios sit inside this data. In the first, the margin expansion is mostly structural, not cosmetic. The one-time items were small relative to the underlying improvement. Services keeps compounding, energy normalizes in Q2, inventory clears as new models launch, and the CapEx being deployed today becomes the revenue engine of 2027. In the second, the margin peak was partially manufactured by non-recurring items, volume stays soft, inventory builds further, energy takes longer to recover than expected, and the $2 billion per quarter going into infrastructure keeps weighing on the income statement before the payoff arrives. Both scenarios are consistent with the numbers you just watched. Here's what the data does give you clearly. 5 things to watch next quarter. Margin without the one-time items. Which direction inventory moves from 27 days? Whether energy recovers. Whether Tesla finally discloses FSD as its own revenue line. And whether Robotaxi starts showing economics, not just miles. Those 5 numbers will tell you more about the next 12 months than anything else. The quarter raised the right questions. The answers come next.